Most people buying a $500,000 starter home right now think they're leveling up. They're not. They're locking themselves into 30 years of financial pressure and calling it success. If your mortgage requires 2 full-time incomes just to feel manageable, that's not security. That's dependence. And the dangerous part? You won't feel it on closing day. You'll feel it 6 months later, when you hesitate before ordering dinner out. When you stay at a job you hate because the payment is due on the 1st. When a broken water heater feels like a financial emergency instead of an inconvenience. Nobody talks about this part, because culturally, buying the house means you made it. But what if the number that's supposed to represent stability is the exact number that removes your flexibility? Before you sign a $500,000 contract, you need to understand what that payment actually does to your options, your stress level, and your future wealth. Because this isn't just about a house. It's about leverage. And leverage magnifies everything. So what does that actually mean in dollars and cents? Let's look at a typical $500,000 starter home today. Not the fantasy version, not the Pinterest version, but what a normal family would really face. In cities like Denver or Austin, $500,000 doesn't buy luxury. It buys normal, about 1,200 to 1,500 square feet. 3 bedrooms, a yard roughly the size of 2 beach towels. No indoor basketball court, no wine cellar, no secret panic room, just normal. And that's the entry point. Now compare that to income. The median household income in the United States is around $84,000 per year. That means the typical family earns $84,000, and the typical starter home costs $500,000. That's nearly 6 times income. Historically, healthy housing markets hovered closer to 3 times income. We are almost double that. If your brain is quietly going, that doesn't feel sustainable. Congratulations. Your brain works. Now let's talk about the first hurdle. The down payment. You've always heard it. You need 20% down. On a $500,000 house, that's $100,000. In cash. The median savings account balance in America is around $8,000. That's not a small gap. That's a canyon. Even if you saved $8,400 per year, 10% of median income, it would take nearly 12 years to reach $100,000. And that assumes no job loss, no medical emergency, no car breakdown, no rising home prices. Life does not behave that politely. So what happens? Most people don't put 20% down. They put 5%, maybe 10%. And that's when something called PMI shows up. Private mortgage insurance. It sounds harmless. It isn't. It's insurance that protects the bank in case you default. It does nothing for you, but you pay for it every single month. Think about that for a second. You're paying extra because you don't already have enough money. That's how the system is structured. Now let's build the real monthly number. Not the one in the ad. Not the starting at payment they highlight in bold. The real one. Let's say you put 10% down. You borrow $450,000. At current interest rates, your principal and interest are about $2,850 per month. That's just the loan. Now we start stacking. Property taxes. Around $500 per month in many markets. Homeowners insurance. Let's say $300 per month. And that number has been rising quietly. Maintenance. Roofs age. Water heaters quit. Appliances don't care about your budget. There's something called the 1% rule. Homeowners should expect to spend about 1% of the home's value per year on maintenance. On a $500,000 house, that's $5,000 per year. About $417 per month. Now add PMI because you didn't put 20% down. Another $300 per month, give or take. Now total it up. $2,850 for the mortgage. $500 for taxes, $300 for insurance, $417 for maintenance, $300 for PMI. That's about $4,367 per month. And that's being conservative. No HOA, no major repairs, no surprise tax increases, no renovations. $4,367 every month. No pause button. Now here's where it gets interesting. When a fixed expense crosses a certain threshold, it changes how you think. It changes how you negotiate at work. It changes how you take risks. It changes how you respond to opportunity. Because when $4,367 leaves your account every month, you don't think about growth. You think about survival. You don't quit the toxic job. You don't take a pay cut to pivot careers. You don't start the business you've been thinking about. Because the mortgage doesn't care about your dreams. It wants its money. Banks typically want housing costs under about 30% of your gross income. To qualify for a $4,367 payment, you'd need around $150,000 household income. To feel comfortable, meaning you're not constantly tight, you'd probably want closer to $180,000. Only about 20% of households in America make that. That means roughly 80% are stretching. And stretching is quiet at first. Then it becomes chronic. Let's imagine a couple earning $160,000 per year. On paper, they're doing well. After taxes and modest retirement contributions, they take home about $9,500 per month. Subtract housing. $9,500 minus $4,367. That leaves $5,133. Still sounds decent. Now subtract life. Car payments, car insurance, groceries, utilities, health insurance, student loans, gas. It's easy to hit $3,900 to $4,000 in non-housing essentials. Now you're left with about $1,100. That's what's left for emergency savings, replacing a laptop, new tires, kids' activities, clothes, travel, random school expenses, everything unexpected. For a family earning $160,000 per year. That's what house poor actually feels like. It's not reckless. It's tight. It's checking your bank account before the grocery store. It's hoping nothing breaks this month. And here's the dangerous part. When you're house poor, small problems become financial stress tests. The AC dies in July? That's $5,000. The roof leaks? $8,000. Unexpected medical bill? Credit card. Now debt starts stacking on top of the mortgage. And the house that was supposed to create security creates fragility. Since 1990, home prices in the U.S. have risen roughly 400%. Median household income has increased about 180%. You can't budget your way out of that gap. You can't side hustle your way out of structural imbalance. Which means this isn't a personal failure. It's a market shift. And when markets shift, strategies have to shift. Now here's the number almost nobody runs. If you invested $4,367 per month at 8% for 30 years, you'd have over $6 million. That's the opportunity cost. Not house versus no house. Security versus flexibility. Equity versus liquidity. Status versus optionality. And I'm not saying don't buy a house. I'm saying understand the leverage you're taking on. Because leverage magnifies everything. It magnifies gains. But it also magnifies stress. Maybe the real question isn't, can I get approved? Maybe it's, if my income doesn't increase for 5 years, will this still feel good? If the answer is barely, that's not margin. That's risk. Maybe wealth isn't the square footage. Maybe wealth is breathing room. Maybe wealth is the ability to sleep at night without doing mental math at 2:13 a.m. Maybe wealth is optionality. And if a $500,000 starter home takes that away, it might not be a dream. It might be a subscription to stress. And the smartest financial decision right now might not be buying the first perfect house you see. It might be waiting. It might be buying smaller. It might be choosing flexibility over image. That's not failure. That's strategy. Because in markets that don't make sense, patience is leverage. And leverage, used wisely, is what actually builds wealth.